Easy numbers to make this simple, right? So if you start at 25 and invest $25 a week into the S&P 500, you will have $20,000 in 10 years, $70,000 in 20, and $200,000 in 30 years. Last video I discussed what happened after I bought the dip. Feel free to check that video. Actually, I think it should be here. I said I stopped buying stocks, but that's not entirely true. I still do buy stocks, but just not individual companies, rather ETFs, exchange traded funds. These are the best things to buy in my opinion and the opinion of others, from Warren Buffett to the Einstein of Wall Street, who I had the opportunity to talk to, and he said that ETFs like the S&P 500 are the best things to buy and hold. This is precisely what I'm going to be doing from here on out, and I've been doing this for almost 2 years now. While I was buying individual stocks on Robinhood, I was also funding my Roth IRA. If you're curious about the IRA or safer investment account, drop a comment down below and I'll make a follow-up video. So while buying the dip, I was also buying a variety of ETFs, including the famed S&P 500. So let's segue into the focus of the video, investing versus trading. As I said before, I see myself as an investor. What exactly is the difference? Well, let's start with the definition. A trader is someone who purchases and sells securities, stocks, ETFs, currencies within a short time frame. Could be as few as minutes to weeks or months. Investor is someone who purchases the same securities but with the intention of holding them over a long period of time, usually up to a year or maybe even decades. Each individual relies on different components to turn their purchases into profits. Traders rely on a variety of short-term factors that determine their positions, aka when to buy and sell. Investors rely on factors that provide information of long-term viability. Will the company withstand the trials of time and continue to provide value to its customers? It's also seen as two opposing styles, one focused on short-term, higher risks, higher rewards, and the other focused on long-term, lower risk and lower rewards. Can an individual be both and not have to choose one over the other? Yes, of course. It all depends on the individual's access to capital and their risk tolerance. How much of their money are they willing to risk to obtain the reward? Monetary profit. Also, keep in mind that investing is much broader than just the stock market. People can invest in real estate, among other things, and this is also something I will be discussing in the future. So, why do I choose to invest rather than trade? Here are my reasons, and I'll provide proof to back up my stance. Trading requires regular monitoring of the market. Investing does not. Trading involves more stress, at least for me, as the risk is higher. Got to put up more money to make the profits in a shorter time frame. Investing in the long term, it's pretty much like the tortoise versus the rabbit. I consistently invest smaller amounts over the years and rely on compounding interest to do the work for me. I want my money to work for me and make me more. So let me give you an example. The S&P 500 is an ETF, which is an exchange traded fund. It's comprised of America's top 500 companies. So essentially, it's one stock that's made up of 500 tiny little pieces of other companies like Apple, Microsoft, Google, Tesla, etc. And the difference is when you're buying an Apple stock, you only have access to Apple, whereas buying an ETF gets you all of them as one stock. Based on previous performance, since history can be used as a potential indicator of what the future holds, the S&P 500 returns 11.82% since its inception. So let's use this to calculate the value of potential investments. And easy numbers to make this simple, right? So if you start at 25 and invest $25 a week into the S&P 500, you will have $20,000 in 10 years, $70,000 in 20, and $200,000 in 30 years. Just like a Netflix subscription, you can build wealth for your future self. This could fund your retirement plans, your travel plans, any health costs, whatever it is, it's your money. Using Robinhood, this is not a sponsored video by the way, you can make this process automatic and you never have to think about it again. You can just make $25 investments consistently over time. However, your future self will be grateful that you did. Also, if you're younger than 25, your returns would be much greater as more time is on your side. You can even start at your own at 18 or even earlier with the help of your parents and guardians. So this is what I'm focusing on, ETFs rather than individual stocks. I will share a list of ETFs other than the S&P 500 I'm buying in an upcoming video. This is to create diversification within my portfolio. Until then, peace.